Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and a warm welcome to my podcast Money Talk for Tuesday the 11th of July. This is Peter Lewis. This is the original Money Talk, and I'd like to thank you for making it one of the most listened to financial podcasts in Hong Kong. You can find it at peterlewismoneytalk.substack.com along with my daily newsletter, and it's also on Apple Podcasts, Google Podcasts and Spotify. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China is on the verge of deflation after consumer prices remained unchanged in June and producer prices fell by the most in 7.5 years. Annual consumer prices fell for the fifth consecutive month and at the weakest rate in more than 2 years. China's annual producer prices sank 5.4% in June compared to the same period a year ago, a ninth straight month of decline and the steepest pace since December 2015. The US banking regulator has announced stricter lending rules for mid-sized banks following the collapse of Silicon Valley Bank, Signature Bank and First Republic earlier this year. The new rules will require the mid-sized banks to report the effect of losses on their assets, on their capital levels, and to keep an additional 2% of capital to absorb any losses. Indebted Chinese property developer Cathaysia has been served with a winding up petition in Hong Kong. The court filing by Singapore-based hedge fund Broadpeak Investment relates to the non-payment of 170 million renminbi in onshore bonds. That's worth about $24 million. And a bearish Goldman Sachs report on Chinese banks, which sent the Hang Seng Mainland Bank Index down 10.5% last week, received fresh rebuke from the mainland on Monday. Merchants Bank, whose shares lost 12% after Goldman's cut its price target on the lender for the second time in 3 months, said the Goldman's report is illogical in the way it calculates the potential losses, lacks basic common sense, and also overestimates its exposure to the local government financing vehicles. And one of China's largest hedge funds, Shanghai Bankshare Investment, also dismissed the report on Monday, saying the prediction that local government debts would erode Chinese banks' profits and push up their bad loans will likely be proven wrong. On today's Money Talk, we're joined by Asian fund management industry consultant Stewart Aldcroft, James Wong, who's Chief Executive Officer at Cathaysia Securities, and our US economics correspondent, writer and broadcaster Barry Wood.
Money Talk.
On Wall Street, US stocks edged higher on Monday as investors looked ahead to the release of US inflation numbers on Wednesday and a slate of earnings from large banks this week. The three major indices snapped three-day losing streaks. The S&P 500 rose 0.2% to end at 4,410. Industrials led the gains. The Dow added 210 points, or 0.6%, to close at 33,944. Meanwhile, the Nasdaq Composite gained 0.2% to 13,685. Second quarter earnings season kicks off on Friday, with banking giants JP Morgan Chase, Wells Fargo, Citigroup and BlackRock all reporting. Hong Kong's Hang Seng Index was boosted at the open by news of the end of the regulatory crackdown on Alibaba, Tencent and other platform companies. At one stage it was up 2.3%, but the city's benchmark index gave up almost three-quarters of those gains to end the day 114 points, or 0.6% firmer at 18,480. The tech index rose 1.1%. Shares of Alibaba jumped 3.2% following the end of the three-year regulatory crackdown. On the mainland, the Shanghai Composite climbed 0.2% to 3,204. And futures markets are pointing to gains of about 100 points for the Hang Seng at the open. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Peter Lewis's Money Talk.
And on this Tuesday morning, we welcome our regular Tuesday morning commentator, Asia fund management industry consultant, Stewart Aldcroft. Morning, Stewart.
And good morning to you, Peter, on this bright, sunny day, which is a Tuesday morning, as you say.
Yep, it's going to be hot and sticky. We welcome also James Wong, Chief Executive Officer at Cathaysia Securities. Morning to you, James.
Good morning, Peter.
And back in Washington, D.C., after his trip across the U.S. for Independence Day last week when we spoke to him, we had with us our U.S. economics correspondent, writer and broadcaster, Barry Wood. Morning, Barry.
Good morning, Peter.
Let's start with China's economy. China's annual producer prices sank 5.4% in June compared to the same period a year ago. That's a ninth straight month of decline and the steepest pace since December 2015. The producer price index accelerated downwards from a drop of 4.6% in May, and it was faster than the 5% fall forecast by analysts polled by Reuters. The reading was partly driven by falling commodity prices. And annual consumer prices were unchanged in June, weaker than the 0.2% rise in May, but declined 0.2% compared to the previous month. It was the fifth consecutive monthly fall and the weakest rate in more than 2 years. I tell you what, James, let me get your thoughts first on this. I mean, looks like there's a real risk of deflation in China at the moment.
Yeah, I was talking to some reporters covering China economy, and his words were, it's been 10 years since he's seen like 2 consecutive months of China's CPI dropping below 0.2%. And it's really something that people are starting to feel on their real life. And I think the question all comes down to whether the central government or the PBOC is going to do something to stimulate the economy. And right now, we've for about a month and a half now, we've seen rumors flowing around telling us there will be a package of stimulus plans that's going to work on the monetary policy side and fiscal policy side, and probably most likely on the real estate property side. And right now, we've seen very few of them. And the only thing that we've seen towards the end of May, from the end of May towards mid-June, was some slight changes on open market rates. And apparently that's not enough. And I don't really think that's the end of it. And from what Premier Li Qiang has said in recent days, I think there will be more. But the problem is what kind of stimulus there will be, and how the stimulus package is going to impact the real estate the sector. I think the real estate sector is the key of all economic recovery that there might be in China, and I think for the past month and a half, there have been 2 times that the market sees rumors flowing around, majority of which was on real estate. But we've seen the PBOC only raised 5-year LPR by about 10 bips. That's a lot lower than what I've expected, and even lower than what the state media was expecting. And I think there will be more. Isn't
it a bit ironic that here we are worrying about China getting into a deflationary time period after sort of quite healthy inflation numbers, and yet in the West they are panic-struck by the very high levels of inflation. So it's a dichotomy in some respects. But for consumers in China, deflation is not a bad thing. It means lower prices. So we in the financial world may not like it, but for many consumers, it's actually quite a positive thing. Of course, you have to realize that what is the cause of it, and property prices are very much the cause of it, as James has pointed out. And China has a very serious property problem. Far too many empty properties, far too many half-built properties, far too much lending against all that. And with a position where interest rates are sort of fairly flat at the moment, there's a debt problem as well associated with it. And China is going to have to worry more about that than I think it will need to worry about consumer prices.
Are prices falling simply because there's not enough demand?
I think
that's
so.
True,
yeah.
Barry. The demand has fallen off since the recovery from COVID, and since people started going out a bit, and that they're not spending in the way that had been forecast. And the consequence of that is that not only are they not spending, but the need to produce goods for them to spend their money on is declining. And I think this is another cause for the concerns is being expressed.
Barry, let me ask you, this seems to me it could be significant for the US economy and the global economy. The last time we saw deflation or a prolonged period of deflation in China was 2009 during the global financial crisis. And then China exported that deflation around the world. Do you think the same thing could happen again? Because if that's true, it's going to have a significant impact for the Fed, for the European Central Bank and their outlooks for inflation.
Peter, just remind me, or James or Stewart, just remind me, was that the case that the renminbi during that period was weaker than it is today? Did that deflation get exported because Chinese goods were too cheap, or were there other factors?
I think the renminbi was at a much higher level than it is today compared to the US dollar. Remember that over the last 10, 15 years, the renminbi has strengthened quite heavily against the US dollar. It's weakened recently, but it's been relative to 10, 15 years ago. It's a lot stronger as a currency.
Yeah, I in answer to your question, Peter, I don't think there's any doubt. Please export some deflation to the U.S. because, we're at 4 to 5%, coming down from 9%. But it's still too high for the Fed, which is why interest rates are likely to rise next week. So I think if the prices on Chinese goods, on which we're absolutely dependent, if those prices are going to fall, I think that would be welcome news.
The problem is, James, doesn't this become sort of like a self-fulfilling spiral, though, that as you start to see deflation, you start to see lower costs at the same time, people start spending less as well because they see the decline in their asset prices, particularly their home prices. Debt starts to grow again. It all starts to feed off of itself, doesn't it?
Yeah, that's why we think real estate is the only problem. It's a rudimentary problem that needs to be solved. And there was an interesting calculation on home prices in Shanghai based on the income, the level of increase of incomes for the past 10 years, and the level of increase for home incomes expected for the next 10 years, and then a different interest rate. So, long story short, the home prices in Shanghai, based on that discount cash flow model, was supposed to be dropping another 15%, which we haven't seen yet for the entire year, for the past year. And because first-tier cities, they've been holding up pretty strong on home prices. Second tier, third tier, not that much. Fourth tier, even a lot worse. So we've seen a real estate market basically frozen. People are not willing to sell, not willing to buy.
If prices are falling in China, I wonder what the impact of that is on wages. One reads that with so many young people coming into the market, their wages are really quite low, much lower than had been expected. But if you've got homeowners with mortgages, then of course those mortgages are at a higher price, and it's much more of a squeeze if your income is not increasing, let alone going down.
Sure, you're right, Barry. But the issue is also that in China, young people, the unemployment rate among young people is very, very high, 25% or more in the major cities. And so this will be a cause of some discontent. If they can get into the market, maybe they will bring down wages as well. So wage inflation will fall, and there are lots of consequences about the circumstances that we're discussing here, which for most part are not that good, and so they will require quite a lot of management by the authorities in China to try to get it right. I'm not sure how they will do it because it's very unclear at this stage. But I think what we're talking about is some risk in the Chinese economy that things will maybe not go as well as expected. And that might be another reason why they're willing to talk again to the US and talk to other parts of the world, because there is benefit in being part of the global community when these things occur.
James, what do you make of the latest measures that the regulators are putting on banks to try and support property developers on the mainland, in particular trying to get them to extend loans that are owed by the property developers? And of course, this is coming at a time when we saw that Goldman's report about the banking sector last week and the impact already of existing loans on it. There seems to be a lot of concern about this.
Yeah, it's been a long time, or I have never seen Goldman issue 3 reports on China banks with a negative view. It's not normal, and of course I can expect China banks have some kind of comeback to Goldman, but I think Goldman is still having a dominant saying in the research industry, not like some other banks. So people are treating Goldman's view seriously. But in terms of banking valuations, I think we've all known that the quality of capital for China banks are probably not as good as they claim to be. So the valuation of banking, the China bank sector in Hong Kong has always been lower than what their counterparts in A shares. So, but that's not going to change anytime soon, because it's still bear the cross of being a value trap. So that's probably going to stay another a prolonged period of time. And then for the regulators' support on banks for real estate sector, I don't think that's going to help the real estate sectors that much, because we've seen right now a steep drop in land sales in China. It was a drop of 30% annually for the year 2022, and it was based on that very low base from from January to May of last year. January to May this year, we've seen another 22% drop in land sales. So we've seen a shrink in both demand and supply for the housing market. And just to let banks support the real estate developers and probably having some help on their debts are not going to solve the demand and supply shrinking problem.
Let me turn, Barry, to Janet Yellen's visit to the United States. She wrapped up her 4-day visit saying that US-China ties were on a surer footing despite significant disagreement. She said her visit's going to help build a resilient and productive channel of communication between the countries. And she also emphasised that the two countries could benefit from trade, and she tried to stress to Beijing that diversifying supply chains wasn't the same as decoupling. Barry, let me get your personal thoughts first on how you think her visit went. Was it successful in the end?
Yes, I don't think there's any doubt about it. It was very successful. However, that's not the way it's being played in the Democratic media and in the Republican media. They both have ganged up on Ms. Yellen, saying that she's embracing a dictator and that it was a mistake that she went there. They want to focus a lot on the fact that she bowed too much when she met these people. But I think that what you get, that I think was rather well done, was this balance. On the one hand, she said, look, there are lots of issues that remain. The security issue is real. We don't like what China did in terms of the export of these important minerals. We don't want to have any kind of further problem. We don't want to decouple. She said that diversifying the supply chain is not decoupling or even de-risking. So, I mean, I thought it was quite good. What I find interesting, Peter, is the notion of her saying that there's ample room for trade and investment. There is absolutely no interest among United States fund managers to come back now into the Chinese market. I think they may later, but right now, boy, there is remarkable unanimity against China.
I think Yellen did a very good deal with this. She will inevitably want to promote the fact that she was in China. She spent 4 days there. She spent a long time talking to her opposite numbers, and she's talked up the purpose of the visit. And certainly from an independence perspective, she looks as though she did a really good job. Of course, the politicians back in Washington who are habitually negative towards China will want to rubbish it. And I think that's where there is a clear problem going on, because politicians worldwide are doing the same thing about China, and I don't think they are really looking at China in the correct way. You know, whatever is the correct way, but they look at it from a negative perspective, a challenging perspective. They think China is there to attack them. None of these things are for real, but it's very difficult for people to be persuaded otherwise, especially if they don't get very close to China, they don't visit it, they don't listen to China.
Mm. James, how is this being perceived on the mainland, this visit?
I think people are still kind of skeptical for Janet Yellen's visit, because before her visit, there were several restrictions coming out of United States. For example, I think the President Biden is going to sign the executive order to restrict PE funds and venture capitalists to invest in high-tech firms in China very soon. And right now they are saying U.S.-based cloud service providers may not provide services to Chinese companies, and along with a lot of other restrictions that come out of the United States. So people are skeptical. But I think both China and U.S. want to talk to each other, because on the U.S. side, even though they are trying to diversify the supply chain, but this whole process might take 5 to 10 years, more likely 10 years or so. So they still rely on China for supplies. And on the China side, I think Barry raised a very good point of young people having a high unemployment rate. And that high unemployment rate just so happens coincides with the steep decrease of industrial output for tech firms. And the reason that the industrial output for tech firms in China has dropped that much since the end of last year has a lot to do with U.S. restriction on tech firms and tech hardwares and softwares to China. So I think both these countries want to talk to each other.
Mm. Did the Chinese side, did they buy the argument that the US was, Janet Yellen was trying to make quite strongly, that diversifying supply chains is not the same as decoupling? And she was trying to say this is just a sensible response to what we saw happen during the pandemic, and it's totally natural for countries now not to want to rely on a single country for its supply chains, but that doesn't mean to say the two countries are disengaging.
I don't think this is a country-level decision. I think it's more like a firm-level or company-level decisions, because the manufacturers that I know in China has already are learning to live with this kind of transfer or shift in production chain in supply chains, because a lot of the U.S. companies, especially the bigger ones, if they are trying to place an order with a Chinese manufacturer these days, they will probably ask if this Chinese manufacturer has a base outside of China. If the manufacturer said tell their U.S. customers that no, I'm only based in China, that order probably won't happen. So this is a wide level of company decisions instead of a country level decisions, I think.
What about the other argument that the US was trying to make, Stewart, that US sanctions, these are very narrowly targeted on areas that affect national security? And Janet Yellen went to great lengths to try to say, we're not trying to hold back China's economic growth. Do you think that's true?
Well, I do think it's true, yes. But I don't think that would be necessarily agreed upon by senators in Washington. I think they would probably believe otherwise. They probably believe that all their sanctions are having a massive effect on China and causing significant damage. I don't think that is the case at all. And I think that China, in any event, China would be pretty well placed to find ways to work around those restrictions.
Yeah, I disagree a bit with that one, Stewart. I think that the Americans and the Europeans and now the Japanese, I think, really are trying to restrain the growth, certainly in the high-tech sector in China. So is that capping China's rise? That becomes a semantic issue. I think you could certainly make the case, yes, they are. They're certainly trying to hold them back. We are now 5.5 years into tariffs and sanctions. There's been no movement on this at all. This is Trump-Biden unanimity, although neither one would want to say so. So we've got a problem here, and we'll see that. But I think Stewart and James, certainly they're correct in saying that these two countries are tied together. I mean, if there's slow growth in China, they'll need to export more to Europe, Japan, and America. And the Americans want those low prices. Send us to the deflation.
Mm. Does the Biden administration try to distinguish its China policy from what came before it under the Trump administration? Do they because the Trump administration was openly hostile, wasn't it, in some ways, with all these sanctions it imposed? Does the Biden administration see itself differently, or is it just a continuation of what we saw under President Trump?
Well, they do see themselves differently, but they don't talk much about it. And I think when you analyze it, you find that there's no difference at all.
Mm.
Certainly, looking at it from where I'm sitting, there is no difference at all.
Mm. Okay, James, let me get your thoughts on the markets. There was quite an interesting reaction yesterday, wasn't there, to the news of the end of this 3-year tech crackdown on Alibaba, Tencent, and other platform companies after that almost $1 billion fine for Ant Group. But the investors didn't seem to buy into it. The Hang Seng was up at the open, but then gave up most of the gains. Do you think investors are not convinced that the problems are over?
Yeah, I think they're trying to make use of any kind of good news these days that are available, because there aren't many right now. And a group being fined a exact number of a definite amount of money, and having the hope of being listed as a public company probably in the near future has, I think, made a lot of investors happy, but not that much, because we've seen the trading volume still below 900 billion. So that basically says the problem of Hong Kong market right now, because people are probably going to use different kind of news to trade up and trade down, but the trading volume is a lot lower than the average daily trading volume for the past year and for the first quarter. And basically, I think for the Ant Group itself, it's a good news, and for Alibaba, it's a good news, because for the announcement that Ant Group made basically calculates its own valuation, which is about 70% lower than the time that it first filed for a IPO in 2020. But 70% lower is still a lot better than no valuation or negative valuation.
But that's still $220 billion it's basically cost the Ant Group, this regulatory crackdown.
Yeah. So I think that the crackdown on tech firms has been confirmed to end for about a year now. But this, I think, really draws a line that says there will be no more crackdown, and all these tech companies are free to go to the capital market and to raise funds.
Stewart, what do you think it's going to take to get overseas investors back into Chinese equities? We saw a report from Goldman Sachs Prime Services Unit. They say that foreign hedge funds have now unwound 70% of their buying that occurred during that initial euphoria between November and January, when China eliminated its lockdown restrictions and reopened. But foreign investors just don't seem to want to be in the market at the moment.
No, and the main reason is exactly the same as retail investors, and that is that the market is going down rather than up. I think if there were any sustained upward movement in markets, then we would probably start to see some nibbling, but it'll take a little bit longer. It is basically the market movement, and China has been negative particularly by comparison to the US. But Europe is flat, so not particularly attractive either. Japan has been very positive, and that's attracted a lot of money. Fund managers go where the markets have already moved, and we always know that. Retail investors buy at the top and sell at the bottom. It's a time-old adage which has worked for 70 years, and it continues to work today.
Okay. Barry, could I finish off with you and ask you about some of the US economic data that we've had? Because we've got important inflation data coming out this week on Wednesday, consumer price data, and then producer price data from the US on Thursday. We had the jobs reports last week. The ADP report was absolutely stellar, over 400,000 private jobs. But the official job report, a bit more sober, 209,000 jobs last month. Still, though, the jobs market is still pretty strong, isn't it?
Absolutely. Look, this is a remarkable period in the United States economy. To have interest rates now at their highest level in 16 years, to have 10 successive increases over the last 14, 15 months, and yet to have the unemployment rate at 3.7%, job creation high, economic growth at 2 to 3%. It's a remarkable time. So I see no reason why this wouldn't continue.
Okay. Well, thank you all very much for your thoughts. You heard there our US economics correspondent over in Washington, D.C., Barry Wood. Also, James Wong, Chief Executive Officer at Cathaysia Securities. And then our regular Tuesday morning correspondent, Asia Fund Management Industry Consultant, Stewart Aldcroft.
Peter Lewis's Money Talk.
Thank you very much for listening this morning. I'll be back tomorrow with more business and finance headlines. To discuss them, I'll be joined by Enzio Von File, founder of Financial Shield, and Hao Hong, chief economist at Grow Investment Group. With a view from Japan is Nick Smith, Japan strategist at CLSA. If you want some more information on some of the top stories from the region, please take a look at my daily newsletter on peterlewismoneytalk.substack.com. See you tomorrow.
Money Talk